Hey, I'm Emma, with Wealth Builder. Alright, folks, in this video, I'm gonna break down the top 3 things you absolutely should not do when you're trading. This isn't just for newbies, either. Even if you've been trading for a while, there are some traps you can still fall into. So, pay close attention, and make sure you avoid these 3 mistakes at all costs. If you find this video helpful, don't forget to hit that subscribe button. Alright, so the first thing you absolutely should not do in trading is to trade without deciding on a time frame. If you're someone who struggles with taking profits or you feel like you're not doing well, you definitely need to pay attention to this. And by time frame, I mean your trading style, right? There's the time frame for day traders, and there's the time frame for swing traders. Day traders aim to grab small price movements quickly. Swing traders aim to capture larger price movements over a longer period. You guys absolutely need to clarify whether you're doing day trading or swing trading before you enter a position. If you realize you haven't been doing that, write it down on a piece of paper before you trade. Or even just make a note on your phone, saying, I'm doing day trading or I'm doing swing trading. A lot of you probably use computers for trading, so you could even use sticky notes, right? Whatever method you use, make sure you stick to that rule. Because if you don't know where to take profits after you enter a trade, the biggest reason is that you haven't decided on a time frame. For example, whether you're going on a short trip nearby or a long vacation far away, even just going out to different places, the prerequisites change depending on the purpose, right? Like, what to bring, your budget, how much money to take, or even whether it's a day trip or an overnight trip. All the prerequisites change. And what you should do changes depending on those prerequisites, right? If the prerequisites are different, the operation, and by operation, I mean what you should do, changes. That's why you need to decide on the prerequisites first, whether you're doing swing trading or day trading. If you don't decide on the prerequisites, you won't even see what actions you should take. Even the most skilled trader can't do anything if they don't decide on a time frame, even after entering a trade. It's because you've decided on a destination that the things you should do naturally fall into place. In other words, where to take profits naturally falls into place. So, if you're feeling lost, it means your prerequisites are wrong from the start. This time frame I keep talking about is the same as your destination. If your time frame is set, your destination naturally falls into place. You'll start to see where you should take profits. Especially for beginners, you don't really think about whether you're doing day trading or swing trading, right? That's why you can't win, and you don't make any profit. Even for more experienced traders, there might be times when you want to try swing trading depending on the market, even though you usually do day trading. But if you enter a position with a different time frame than usual, and the market moves against your prediction, you won't have the sense of how to manage your funds, how much price movement to expect, because you're not used to it. All those senses change depending on the time frame. It's like when you're cooking, you change the heat depending on what you're making, right? If a day trader tries swing trading, they won't know how to adjust the heat. So, even experienced traders become beginners again when they change their time frame. This is a problem that can happen not just to beginners, but to experienced traders as well. So, you just enter a trade without thinking about the time frame, and that entry is based on technical analysis. You blindly believe in that technical analysis, thinking, this chart pattern looks good. I'm confident here. I'll buy with a bit more money. And then, you end up unable to cut your losses and just keep averaging down. Well, that's a road everyone goes down, right? Anyone here who hasn't done that? I've done that before, of course. Therefore, the reason these things happen is all because you haven't decided on a time frame. So, beginners, just decide on a time frame first. Decide before you enter a trade. And for more experienced traders, when you trade with a different time frame than usual, make sure you only fight within that new time frame. If you decide on a time frame, what you should do naturally falls into place. But even if you show the same chart, what you should do, the operation, changes depending on the time frame. This is a 1-hour chart of the S&P 500. In the short-term 1-hour chart, it appears that the index will continue to decline as it has broken through the horizontal line where it previously stopped falling. However, when viewed on a daily chart, it can be seen that this is a correction phase within an upward trend. Therefore, in this case, it is better to align with the longer-term time frame and enter a long position after confirming the short-term decline. So, now that you've heard this, you realize that the technical analysis you look at changes depending on the time frame, right? Which means you need to think about when your time frame, your trading style, makes it easier to do advantageous trades. When you enter a trade, what becomes important is taking profits, right? When taking profits, it's about how far you extend your profits. You don't know where to take profits. In this chart, the price has stopped falling at the key level of 5,000. One potential target for taking profits is the recent high, which is this line. This is a point where you might want to consider taking profits. In this case, the price broke through that line, then fell back, bounced off the support line, and went up again. The next profit-taking point would be around the key level of 5,500. Technical analysis. Any technical analysis shows you the advantage of going up or the advantage of going down, right? For example, there's the MACD, which is a typical oscillator. If the MACD shows a buy signal, the persistence of that signal changes depending on whether it's a short-term, medium-term, or long-term buy signal, right? Of course, even if the short-term MACD shows a buy signal, it doesn't mean it will last forever, right? Compared to medium-term or long-term buy signals, there's a higher chance it will switch quickly. So, when thinking about taking profits, you need to clearly decide what time frame you're trading in. And based on that, you decide which technical analysis to look at. And finally, you'll see where you should take profits. Alright, so once you decide on the time frame for your entries, that discipline will naturally kick in, and the things you need to do will start to fall into place. But if you don't have a clear time frame, you won't know where to take profits, right? So, if you just enter trades without thinking about the time frame, you're basically not disciplined. And that's kind of like those guys and girls who are unpopular with the opposite sex. You know, the ones who keep messaging on Facebook Messenger, right? I used to be like that too, and everyone goes through that phase. But just keeping up the Facebook Messenger conversation doesn't mean anything, right? If you send a message on Facebook and don't get a response, it's pointless. You should just ask them out already. Of course, timing is important. But the whole point of using Facebook Messenger is to ask them out, right? So, even in the case of love, the difference in purpose can affect the accuracy of your actions. Well, anyway, let's put love aside. Even in the stock market, you don't want to be a loser. Alright, so if you don't have discipline, if you don't have rules, this whole process from entry to exit just doesn't work. You can enter a trade, but you won't know where to take profits. In the stock market, it's important to set your own rules. No one's going to tell you what to do. Your boss isn't going to say, hey, you need to do this by this time. You have to set your own rules and make money within those rules. Now, after hearing all this, some of you might be wondering which time frame is right for you. And I'd say that if you're struggling to win and you can't seem to accumulate or hold on to profits, swing trading is the best option for you. Okay, so one of the big advantages of swing trading is that it's perfect for people with day jobs. Most of you are probably trading while working, so it's really ideal for that. With short-term trading, you have to spend a lot of time watching the charts. So, if you're a company employee and a trader, swing trading definitely has an advantage. Another thing is the risk-reward ratio, the profit you make when you win. It's the difference between the profit and the loss when you cut your losses. And with swing trading, the profit tends to be bigger than the loss. You've all played fighting games or Pokemon, right? Imagine if you lose, your HP goes down by 1 point. But if you win, you get +3, +4, or +5 points. That's way better, right? For example, if you get 3 points when you win and lose 1 point when you lose, you can break even if you win once and lose 3 times. You win once, you get +3 points, and you lose 3 times, you get -3 points, so it's even. The best thing about this is that you can feel okay about losing. Which one is more mentally stable, trading while thinking, it's okay to lose, or trading while thinking, I really need to win soon? Trading for a relatively long period like swing trading is less stressful. Watching the charts all the time while risking money is really mentally taxing. It's basically impossible for most people. So, like I said before, you don't have to watch the charts as much with swing trading, which means less mental stress. Okay, so the second thing you absolutely shouldn't do is trade without setting a stop loss. The most common way beginners blow up their accounts is by endlessly averaging down, right? Like, you go long thinking it's gonna go up, but then it drops. But you're like, nah, it's gotta go up, the chart looks good. So you keep adding to your position, and boom, your losses snowball and you're wiped out. Classic, right? Come on, who's been there? Yep, we all have, it's a rite of passage. But here's the thing, and this is super important, always base your entries on the higher time frames. Even if you're a short-term trader, a day trader, whatever, always use the higher time frames as your guide on every time frame. Sure, your profit targets might change depending on the time frame, but if you're always trading with the higher time frames in mind, your stop-loss levels will always be consistent. For example, let's explain using line trading as an example. We use lines on a longer time frame as the basis for our trades. This way, the stop-loss criteria will be the same, since the basis for entry is the longer time frame. Regardless of the time frame you trade in, always keep the stop-loss criteria consistent. This is the easiest way to understand. So, like, looking at this chart, right? It was going up, then it kinda pulled back, bounced off that $5,000 mark. It breaks through the recent high at $5,250. And get this, that old high, it's now acting support line, and the price just keeps climbing. Now, if you're thinking, hey, it bounced off that support, looks like it's heading up again, and you want to jump in with a long position, your stop loss? It's gotta be just below that line, duh. I mean, even if it dips a bit, and you're like, oh, but 5,000 is down there, I can move my stop loss, don't even think about it. That's a one-way ticket to getting wrecked in the market. Whether you're day trading or swing trading, it's always better to base your trades on the longer time frames, the bigger picture, right? That gives you a real edge. Now, your profit targets are gonna change depending on the time frame. Like, if you're swing trading, you might hold for weeks or months, so you're aiming for a much higher target. But if you're day trading, you're not holding overnight, so you gotta figure out how high it'll go within the day. So, yeah, profit targets change. But your entries? Keep them consistent, based on the technical analysis of the longer time frames. That way, your stop-loss levels stay consistent too, and you're not all over the place. So, the best way to solve this is to just commit to only trading based on the higher time frames entry signals from the get-go. That's the real key. Of course, the speed of actually executing your stop-loss will vary. Day trading, you gotta be quick. But swing trading, you might wait for a 1-hour or 4-hour candle to close, considering it might with a long lower shadow. So, while the stop-loss level stays the same, the actual execution changes. But the important thing is keeping that stop-loss level consistent. So, bottom line, don't take trades in wishy-washy areas. Oh, and by the way, try to avoid setting stop-loss orders if you can. If you can watch the charts, just close the trade manually at market price. That's super important. Why? Because stop-loss orders get triggered, you know? But, if you're not confident in your ability to cut losses, if you tend to move your stop-loss line, then definitely set a stop-loss order. Absolutely. If you know you struggle with cut losses, set those orders, no question. Alright, last but not least, the third thing you absolutely cannot do in trading. Changing your time frame and stop-loss rules. You decide which time frame you're playing in, and that naturally sets your profit targets, right? And we talked about how if you stick to using the higher time frame for your entries and stop-loss, your stop-loss stays consistent. But here's the thing, people often enter a short-term trade, a day trade, and then it goes against them. They can't handle the loss, so they just decide to turn it into a swing trade on the fly. So, the whole point is, to stop yourself from doing that, you gotta just stick to using the higher time frames lines and technical analysis for all your entries. Just decide on your time frame at the start. Swing trading's probably the best bet, honestly. And once you've picked your time frame, even if you're day trading, you still gotta check those higher time frame lines and technicals before entries in. If you do that, you'll avoid those major screw-ups. I've been there, too. I've doesn't cut losses, kept averaging down, and lost big. But I've also won big doing that. But trust me, it's better to just cut your losses early. Way better. If you can't take a loss, you're just making excuses for yourself, and that's a really risky way to trade. So, like I keep saying, just base your trades on the technical analysis of the higher time frame, those lines and stuff. If you only enter trades based on that, you won't be tempted to change your stop-loss rules on the fly. Alright, so in this video, we talked about the 3 things you absolutely gotta avoid in trading: not deciding on a time frame, not setting a stop-loss, and changing your time frame or stop-loss rules. These 3 things, they're not just traps for newbies, even experienced traders fall into them. But if you dodge these traps and stick to your rules, you'll be stacking up those profits, for sure. Especially nailing down your time frame, that's like setting your course, it's super important for disciplined trading. Find a time frame that clicks with you, and build your trading plan around it. And when it comes to stop losses, always base them on the higher time frame, and don't budge. Stop losses are your safety net, they keep your losses small, and ditching them can lead to some serious damage. And once you've picked your time frame and stop loss rules, don't just change them on a whim. Stick to your guns, don't let your emotions mess with your rules, that's the secret sauce for trading success. Hope this video gives you some good pointers for your trading. If you found it helpful, smash that subscribe button. We'll keep bringing you the good stuff to help you trade better, so stay tuned.